I want you to picture a man named Harold in October of 1930. He is a grain farmer in Nebraska. He has worked the same land for 30 years. He has just sold his harvest. He has put the money in the local bank because that is what respectable people do. That money is not speculation. It is not greed. It is not ambition. It is winter food, spring seed, family survival, and next season's hope all piled into one account balance. Then one morning he drives into town needing a little cash for supplies. There is a line outside the bank. The doors are locked. A handwritten sign says the bank is closed until further notice. He can see the building. He can see the teller cages. He can almost feel the vault through the glass. But his money is gone in the only way that really terrifies people. Not stolen by a thief in the night, not lost in a reckless stock speculation, deposited, trusted, and then trapped behind a legal structure he never understood. That is the right place to begin this conversation, because most people are asking the wrong question. They ask, can banks fail? Of course they can. That is not the interesting question. The interesting question is, what exactly is your money when it is in a bank, and what changes when confidence breaks? Most people do not know the answer because the system is built to make them feel as if access and ownership are the same thing. You open the app, the number is there, you swipe the card, the payment clears, you wire funds, the transfer arrives. So your mind concludes something simple. The money is mine, sitting there waiting for me. That is not quite true. When you deposit money into a bank, you are not storing cash in a private vault under your name the way a child imagines a piggy bank works. You are entering into a legal relationship. The bank takes your cash and records a liability to you, in plain English. The bank owes you. Your deposit becomes part of the bank as funding base, and you become, in substance, a creditor of the institution. That is why modern banking works so beautifully in normal times and feels so shocking when it stops working. The shock is not just financial, it is conceptual. People discovered too late that their bank account was not a storage box, it was a claim. Now, I want to be careful here, because once people hear a sentence like that, they immediately lurch into one of two foolish directions. The first group says, so banks are scams. The second group says, yes, but none of this matters because we have insurance and regulators now. Also no. The truth, as usual, lives in the middle. Banking is not a scam, it is a machine. It creates credit, it finances commerce, it keeps an economy moving, it allows idle money to become active money. It is one of the most useful machines civilization ever built. But like every powerful machine, it has stress points, and those stress points are easiest to see in a crisis. The classic stress point is very simple. Banks fund long assets with short liabilities. Your deposit can be demanded. Now, the bank's loans are repaid over time. That mismatch works as long as not too many people want the same thing at the same moment. If confidence holds, the machine hums. If confidence breaks, the machine begins to expose its mathematics. That is what the early 1930s taught in the ugliest possible way. From 1930 to 1933, about 9,000 banks in the United States suspended operations. That is not folklore. That is official history. Depositors did not lose because they were foolish. They lost because the legal and structural protections they assumed did not exist in the way they imagined. Deposit insurance did not yet exist. Central bank support was not used decisively enough, confidence evaporated, and once depositors ran, the system ate itself. Now, if you want to understand why that wave of failures was so devastating, you have to understand fractional reserve banking without the academic fog that usually surrounds it. If you deposit $1,000, the bank does not keep $1,000 in a drawer for you. It keeps reserves and uses the rest to support loans and other assets. Those loans create deposits somewhere else. The system multiplies credit on top of an original base of cash and reserves that is efficient in prosperity. It is fragile in a run. The run is the key. A bank does not need all depositors to show up angry. It only needs enough of them to show up at once. Then the thing everybody thought was money becomes a queue, then the queue becomes a rumor, then the rumor becomes a line around the block, then the line becomes a sign on the door. That is why I have always said the one thing you should study before you study returns is structure. Returns are downstream of structure. When the structure bends, the returns do not matter because access itself becomes the issue. Now, most people hear all of that and say, yes, yes, but that was the Depression. We fixed that. We created the FDIC. We learned the lesson. We did learn a lesson. We did not remove the structure. The FDIC is real. The standard deposit insurance amount in the United States is still $250,000 per depositor, per insured bank, per ownership category, for insured amounts. The historical record is remarkably strong since federal deposit insurance began in 1934. Insured depositors have not lost a penny because of an FDIC insured bank failure. Those are not trivial facts. They matter. They are the reason the modern retail banking system does not look like 1931 every time a bank gets sick. But insurance does not mean what most people think it means. It does not mean every dollar in the system is permanently and instantly safe. It means a particular layer is protected under a particular framework, inside particular limits, with particular administrative processes, under a fund that is built for isolated failures better than for universal panic. That distinction matters at year. In 2025, the Deposit Insurance Fund stood at about $153.9 billion, while domestic insured deposits were about $10.66 trillion. In other words, the fund is a fraction of insured deposits, not a giant vault containing an equal dollar for every dollar insured. If a systemic panic hit the entire banking system at once, you would not simply open the fund and match it line for line. The machinery would move through emergency facilities, resolution processes, government backing, and almost certainly some form of broader state response. That is not a reason to panic. It is a reason to stop speaking carelessly about insurance as if it were a magical physical stockpile. And there is another point that people discover only when it hurts. Even insured money can be inaccessible while a failure is being resolved. You may ultimately be protected and still find yourself temporarily cut off while officials, systems, and successor institutions sort out what comes next. In ordinary life, a few days can matter. Payroll matters. Medical bills matter. Closings matter. Contractors matter. Timing matters. A temporary freeze may not destroy a fortune, but it can still create hardship. That is why I do not like lazy statements such as, the money is safe, full stop. Safe from what? Safe for how long? Safe in what form? Safe with what degree of access? Those are grown-up questions. Now let us fast forward from Depression history to a more modern lesson, because people often imagine these issues live only in old black. And white photographs, Silicon Valley Bank collapsed in 2023. And one of the uncomfortable details was just how large the uninsured deposit base had become. Most of its deposits sat above the ordinary insurance limit. The government stepped in and made all depositors whole, but it did so through a systemic risk exception. That was a policy choice in a contagious moment, not a standing promise that every future bank failure will always be handled the same way for every kind of depositor under every political condition. That event was not a replay of 1930, but it was a reminder that the line between confidence and stress is much thinner than the average depositor thinks. The great irony of banking is that it looks strongest right before people begin to need a lesson in structure. The screens work, the app works, the statements arrive, the ATM dispenses cash. So nobody studies counterparty risk until the counterparty becomes the story. That brings us to the truly uncomfortable part. The part most people prefer not to discuss, because it destroys the comforting fairy tale that all rescues must be paid for by somebody else. Cyprus in 2013 reminded the world that bailouts are not the only way systems handle failure. Depositors above the insured threshold at the Bank of Cyprus saw 47.5% of those uninsured deposits converted into equity. That is not conjecture. That is how losses were distributed. Europe then formalized bank resolution frameworks built around bail in tools, meaning that creditors and certain liability holders can be used in resolution before taxpayers are automatically asked to absorb the damage. Again, I want to be precise. That does not mean every saver in a developed country should expect a Cyprus haircut tomorrow. It means the preferred language of modern crisis management is no longer the taxpayer will always take the first loss. The preferred language is loss should be distributed inside the institution, capital and liability stack as far as possible before the taxpayer becomes the immediate answer. If you hold a simple insured retail balance under the limit at a healthy institution, that may not bother you if you keep large uninsured balances, corporate operating cash, or concentrated liquidity in one place. It should bother you very much. Now we are ready for the question that people actually care about. If a bank is not a vault, if insurance has limits, if access can be delayed, if confidence can crack, then where do you keep cash? The first thing I will tell you is the only honest thing to say. There is no perfect solution. Every storage choice moves risk around. It does not eliminate risk. The adult investor understands trade-offs. The childish investor searches for a magical risk. Free corner of the universe and usually finds a salesman instead. Let us walk through the main alternatives the way a sane person should. Physical cash is the oldest answer. It has obvious virtues. It cannot be bailed in. It is not trapped in a bank resolution. It does not require a password, an app, a wire desk, or an institution's goodwill. In a short deflationary panic, physical cash can be extraordinarily useful because access becomes more important than yield. During the Great Depression, people who had physical currency when others had trapped bank claims learned that distinction the hard way. But cash is not a religion. It has trade-offs. It can be stolen. It can burn. It earns nothing. And in an inflationary environment, cash becomes the asset that loses purchasing power while doing absolutely nothing to fight back. So when somebody says just hold cash, my first question is always, for what type of crisis and for how long? That is the right question. Treasury securities are a different animal entirely. When you own a Treasury bill or note, you are lending to the U.S. government, not to a private bank. You can buy Treasury marketable securities directly through Treasury Direct, which reduces intermediary risk. Treasury Direct is still the government's own system for direct purchases, and Treasury's own materials frame it as a way to buy and hold without going through a bank or broker as the primary custodian. That is not a trivial distinction if what you fear is private bank fragility rather than sovereign fragility, but treasuries are not magic either. If you hold them through a brokerage, you reintroduce intermediary considerations. If you hold them directly, you gain one form of safety and lose some convenience and flexibility. If you sell before maturity, price risk enters the picture. If the sovereign itself becomes your concern, then you are simply moving from private credit risk to public credit and currency risk. Again, trade-offs, money market funds are often treated by ordinary people as bank deposits wearing a slightly better yield. That is sloppy thinking. Money market funds are not the same thing as insured deposits. They are securities. The Reserve Primary Fund broke the buck in 2008, and regulators spent years reforming the sector because of what that episode revealed about liquidity pressure and investor runs. If you use money market funds, you should use them with your eyes open, not because someone on a television panel called them cash equivalents. Equivalent is a dangerous word in finance. Gold is the ancient answer and the one that makes modern people uncomfortable because it sounds old-fashioned until the system itself begins acting old-fashioned. Gold has obvious strengths. It cannot be printed. It is outside the banking system. It is no one's liability. It has survived empires, defaults, devaluations, and policy stupidity on a scale that would make a central banker blush. But gold also has a long history of reminding investors that political risk follows anything useful. In 1933, Executive Order 6102 made private gold bullion holdings illegal for most Americans and required surrender to the Federal Reserve in exchange for paper currency. That happened. So gold is not a perfect solution either. It is a form of independence with storage risk, political risk, and no cash flow. The adult investor can still respect it without worshiping it. Foreign bank accounts and foreign currencies tempt people because they feel like escape. Sometimes they are diversification. Sometimes they are complexity, masquerading as safety. A foreign jurisdiction can give you legal diversification, currency diversification, and distance from one banking system as particular vulnerabilities. It can also give you reporting requirements, access problems, legal unfamiliarity, FX risk, and a false sense of being clever. Americans in particular live under a reporting regime that does not reward laziness in this area. So foreign diversification may be useful for some people, but only the discipline should touch it. Real assets sit at the opposite end of the spectrum: land, property, productive businesses, certain forms of commodity exposure. These things are not bank liabilities. They cannot be bailed in by a bank because they are not sitting on a bank's balance sheet as your claim. But real assets are not liquidity instruments. You cannot buy groceries with a rental property. You cannot fund an emergency with a pasture unless someone will buy it from you on tolerable terms. Real assets shine under some inflationary and currency debasing conditions, but they are clumsy where immediate spendability matters. So once again, you discover what adults always discover: no perfect answer, only combinations. That is why the right question is not, where should I put all of my cash? The right question is, what mix of liquidity, sovereignty, counterparty exposure, inflation defense, and direct control matches the kind of stress I am actually preparing for? That is a much harder question. It is also a much more profitable one. Now, if you want my broad philosophical answer, it is this: do not put yourself in a position where one institution, one legal regime, one interface, one password reset, one wire cutoff, or one resolution weekend determines whether you can operate. Optionality matters more than optimization. People destroy themselves trying to optimize a few basis points of yield while leaving themselves exposed to a catastrophic single point of failure. I would rather earn a little less and sleep inside a structure I understand than earn a little more in a structure I have not bothered to study. That is the real lesson of 1929. Not that banks are evil, not that the state is always helpless, not that you should hide money in a mattress and spend your life waiting for the end of civilization. The lesson is simpler and more difficult. You must understand what a bank actually is. A bank is not a vault. It is a counterparty. A deposit is not stored cash. It is a claim. Insurance is not a magical pile of money equal to every deposit. It is a framework. Access is not ownership. It is a privilege of a functioning system. Confidence is not a law of nature. It is a condition. And conditions change. That is why history matters so much. It teaches you the names may modernize while the structure stays old. In 1930, the structure failed and depositors learned by standing in the cold outside locked doors. In 2008, other structures failed and investors learned by watching supposedly safe instruments melt under stress. In 2023, duration risk and uninsured deposits combined to remind everybody that bank balance sheets still obey mathematics, even when depositors do not study them. Every generation wants to believe it lives after the lesson. In truth, every generation lives between lessons. Now let me leave you with the part that matters most. Crises do not announce themselves in time for your convenience. You do not get a polite letter saying, "Next Thursday your assumptions will be tested." You prepare before the line forms. You prepare before the app crashes. You prepare before the weekend resolution memo is written. You prepare while the machine still looks smooth. That does not mean panic. It does not mean extremism. It means intellectual honesty. Keep appropriate insured balances. Understand where your liquidity truly lives. Know what sits inside the banking system and what sits outside it. Use direct government securities if that fits your purpose. Respect physical cash without romanticizing it. Respect gold without turning it into religion. Respect real assets without pretending they are liquid. And above all, stop speaking about a bank account as if it were a synonym for certainty. It is not certainty. It is convenience married to counterparty risk. Most of the time that marriage works well enough. But when it fails, the people who suffer most are the ones who never studied the vows.